Thank you, Henry. And it's great to be here. And thank you to the Swiss National Bank for co-hosting this event. My name is Hyun Shin. I'm the economic advisor and head of research at the BIS. And it's really my pleasure to chair this second panel, which is on the future of DeFi and the DeFi and the future financial system. And what we'll do is cover a number of, I think, very large questions. The first set of questions have to do with the technology, which is, can the limits to scalability of the underlying blockchains be overcome? And we have the perfect person to talk about this, and I'll introduce the panel shortly. The second question is, what is the prospect of DeFi becoming useful for real-world assets? So this is all about tokenization, about the links between the blockchain and the real world, and we touched upon it in the previous panel as well. And related, there are issues to do with what actually ties the token on a blockchain with the real-world object. And another way to phrase this is to say, what is the limit to decentralization? Do we actually need some legal authority, some way of tying down the claim of ownership in that context? And of course, it gives rise to many different and interesting questions, especially when there is more than one jurisdiction and when there is more than one blockchain. How do we actually reconcile? So as a prelude to this panel discussion, let me just throw a few questions out there for the panel to chew over. Now, we know that in the network economy, there is a natural tendency for network effects to kick in, which is to say, the more that some people use a particular platform, the larger is my incentive to use that platform as well. So there is a kind of winner-takes-all effect. Now, what's been interesting is that this kind of network effects and winner-take-all does not hold for DeFi. And instead, what we are seeing is, if you like, an increasing fragmentation of the blockchain platforms, shown by this graph. This is just a percentage of the total collateral locked in particular layer 1 blockchains. Of course, in the recent past, it was Ethereum, which was by far the dominant blockchain. But what has happened, especially in the last year or so, is that these new layer 1s have muscled in, and they've increasingly established a footprint. And the question is, how could this happen in the presence of network effects? And I think one way that we can approach this question is, what is the cost of using one of these blockchain platforms? And in particular, if we look at the gas fees, what we've seen is that the Ethereum gas fees have been really very, very high recently. It's a kind of, a symptom of the scalability problem that we have seen these other layer 1s really take market share from Ethereum. And another way of saying it is, it's when the gas fees spike here in these blue lines that we see the alternative layer 1s gradually establishing a larger footprint. And so I think this points to a very, very important feature, which is something that Vitalik Buterin himself laid out as his so-called trilemma. And the trilemma is a triangle between three features: decentralization, which is what this conference is all about, and two other features which we think is going to be important. One is security, which comes from decentralization, and the greater the genuine decentralization, the greater will be the security. But then there's also the scalability. And scalability is going to suffer if the security is very, very tight, because the consensus protocol is going to use a lot more in terms of the threshold. And so there is this, I think, technical issue which underlies a lot of the discussion which we need to get to the bottom of. Now, in contrast, if we look at the conventional payment system, we see something which is in great contrast, which is that in the conventional payment system, we do indeed see these network effects that give rise to greater use, giving rise to more activity, and then this attracting even more users to the platform. And here's a chart from a recent bulletin that we published recently on the instant payment system in Brazil called Pix. And this is a payment system where the launch was very recent. It's been in operation only just over a year. And in just over a year, it has actually recruited 2/3 of Brazil's adult population. And 50 million people have actually used Pix to make a digital payment for the first time in their lives. It's free to individuals, and it's virtually free to merchants, unlike credit and debit cards, which have a pretty high merchant fee. And unsurprisingly, what's happened is that the usage of Pix is now poised to overtake credit and debit cards. So could DeFi emulate something like this? I think that's one of the questions that I think we should try and chew on. On the other hand, something that hasn't really been mentioned so far in this conference is another aspect in which the network effects could really kick in, which is the fact that the whole system is sustained by buying coins. And the more the price of one coin goes up, the price of the other coins also go up. And here's a simple average of these bilateral correlations, of these pairwise correlations, and we see that they're all positive, which I think does give a sense of this sense of excitement that we've seen in the DeFi universe, which is the more this ecosystem gathers pace, the more enthusiasm it generates, and that's very much partly linked to the coin prices themselves. It's, for example, very noticeable, and we'll talk about it on the panel, that institutional investors now play a much bigger role in crypto markets, and this is just the trading volumes here on Coinbase, which raises a really intriguing question, and I'd like to sort of explore this further in the panel, which is, to what extent is DeFi sustained only by the inflows of new investors? And what if the system becomes mature and that inflow is actually slowed down? Is that going to actually sustain enough of the enthusiasm to make the system work? And here's a very interesting chart. What I've done here is, in the black line, this is just the annual change. It's just the year-on-year price change of Ether. And the pink bars are the new addresses, so the number of private keys in terms of on all the platforms. And we do see that there is this correlation where the enthusiasm for DeFi has been sustained by the rise in the price of coins. And the question is, will DeFi, has it matured enough that this system will be self-sustaining even when the prices of the coins stabilize? Does it actually need increasing prices, or can it actually sustain itself even with a level trajectory of the coins themselves? Another question that was raised is, how decentralized is DeFi? Of course, as Wen Chan mentioned in the previous panel, probably Bitcoin is probably closest in the spirit to the original DeFi ethos, if you like, and that's part of the reason why the Satoshi Nakamoto protocol was built around proof of work. As we move to proof of stake, and as we move to a system where the insiders have a larger stake in the coins themselves, are we in danger of slipping into a situation where the insiders have a very large stake and they are the ones who actually collect the rents? And this is also another topic that was raised on the previous panel. The way that the blockchain works is that once you win the right to update by attaching a new block, then of course it's up to you to see what orders there are. And this is something that Roger also mentioned in terms of the sandwich trades. And of course you can reorder, you can front run, and actually benefit from knowing what the trades are. And this is what is sometimes called minor extractable value. How much resources can you actually extract from your right to append the latest block? And of course, many of these things would be illegal in the traditional financial system. And to what extent can we actually think of this as being an essential feature? So let me also just raise, I think, a number of questions that I think will be very important when we think about the use of DeFi for real-world assets. So what are the limits to the tokenization of real assets? And how far can we take the decentralization agenda without some intermediary at some point? So I think at the very least, we're going to need a legal system to say that this particular token is pointing to that particular asset. So at some point, we're going to need some intervention of the legal system here. But even so, imagine that we're tokenizing a bottle of wine. It's a very valuable bottle of wine. It's very expensive. And we can even have part shares in the wine. And there are questions like, whose law governs this tokenization? More interestingly, which blockchain is governing the tokenization? So if we have one token in one blockchain issued that's governed by a law in jurisdiction A, another token in another blockchain governed by jurisdiction B, how do we resolve this? And of course, the conflict between legal claims is not new. It also arises in traditional assets. But there's something else here which I think we need to discuss, which is normally when you're missold an asset, you normally have recourse to the seller who has missold you. How far can we actually get the recourse in DeFi? So I think these are the things that I think would be very good to discuss. And we have the perfect panel for this. And I'm going to just introduce the panelists from Hyun, who is my immediate left here. Hyun Brzezek is the CEO and founder of Crypto Finance, which is an asset management company. And Hyun comes with long experience at UBS Asset Management, but also wealth management and the investment bank itself. Before that, he was with UBS, especially as an expert on derivatives. And Hyun has also spent some time at SIX. Next, we have Iota Nassr, who is a policy analyst at the OECD. And she's currently managing the FinTech Experts Group in the Committee on Financial Markets, and she's the leading expert at the OECD on digital finance. Before joining the OECD, Iota also has a private sector background. She was with Merrill Lynch and Citigroup in London. And she's very much straddling the economics and the finance and the technology aspect. Next, we have Thomas Eichenberger, who is the head of business unit at Sygnum, which is a bank that is specializing in crypto. He's a member of the group executive board, And he also has extensive business experience. He was a strategy consultant at BCG, Boston Consulting Group, where he led projects on financial institutions, insurance, and private equity. And last but not least, at the far end is Evan van Ness. Evan is the founder of Starbloom Ventures, which is an early-stage venture fund investing in Web3 projects. And Evan comes with a great deal of credibility as a technical expert because he knows Ethereum inside out. He publishes a weekly newsletter, Ethereum News, which is actually a very important resource for Ethereum developers. And so I think you can see that we have the perfect panel for this discussion. So why don't we take down my slide here. I'm going to take this with me so that I can operate the slides from over there. But let's go to the panel discussion. So what I'm going to do is start off with Evan, because Evan is the expert here on the technology.
No pressure.
So you have a lot of responsibility on your shoulders, Evan. So Evan, the high gas fees in Ethereum, this is something that people have mentioned. Of course, Vitalik has mentioned the beacon chain and sharding as potentially one solution. So tell us a little bit more about what's actually in store to resolve the capacity issue. But also, just reflect with us on what the right capacity is, because if we think back to the Bitcoin block size wars, just having a larger block size didn't really attract people either. And in a way, you need some rents there for the validators for this to work. So if we have an infinite capacity, there's not really that much rents for the validators to actually work with. And so it seems that finding the right capacity is quite a difficult problem. So tell us from your vantage point what you're seeing in this scalability issue.
Yeah, I like to start with the technology because I think that really what really matters in this space is the technology, and that's what will accrue value and attention, and is important to understand over the long term. So you talked about the scalability trilemma, so security, decentralization, and scalability. I would say that basically every chain that we have now has basically just traded away decentralization and/or security for, frankly, relatively little amounts of scalability. It's actually sort of shocking that they haven't been able to get more scalability out of the amount of centralization that they've had. Basically, there hasn't been a crazy amount of innovation in the quote-unquote layer one space outside of Bitcoin and then Ethereum. It's actually surprising how little there's been. I think one important thing to think about for understanding this space is what are we really doing and what really matters? And it's providing a decentralized, relatively trustless, relatively neutral settlement layer. And that's something that is difficult to achieve because you need to have a track record. The Lindy effect matters. And essentially, Ethereum, the long-term goal is to be the settlement layer for the financial system and for the world. And really, I think that anybody that wants to take Ethereum's place should have the same goal. So right now, Ethereum is the main chain is never going to be cheap. It shouldn't be cheap. That would be a mistake. It would trade away the decentralization that is fundamental to thinking about the long-term future of these things. And really, the scalability trilemma is broken by using these things that we call layer two, called rollups. Bitcoin essentially also got there as well. They just have the problem of not being a stateful solution, and so really Lightning is a very difficult technical solution that hasn't really been solved and hasn't really seen any adoption. Ethereum, being a stateful solution, is able to have a much more advanced layer 2 protocol, rollups that basically keep the data on chain but move the execution off chain into rollups. So I don't know, should I stop there? I feel like I've talked for a while.
I think what you said, let me just have one follow-up question. I think what you said something very interesting here, which is some of the newer layer ones, they have traded away security for a little bit more scalability. So tell us a little bit more about that. And we've had the the Axie Infinity hack recently. It seems that the validation threshold was actually quite low there. And they've now gone back and raised the number of validator nodes that needs to sign off on this. So it does seem that there is a fundamental issue here, which is, of course, you can get more throughput by relaxing security. And I think if you push it too far, you're going to get hacked. So what is the right kind of balance here? And is there a kind of what does this tell us about the finding the right capacity? Somehow we have to anticipate from the very beginning what the right capacity is, and getting it right, from word go. Otherwise, trying to adjust the capacity later down the road seems like a very difficult problem.
I think that in technology, the infrastructure gets built as there's demand for it. So I don't think it's a matter of exactly needing to figure out the right capacity right now. I think there are ways that we will build the scalability as it's necessary. I think it's starting to happen right now. As you said, like there's these cross-chain bridges to other more centralized solutions. So one problem with like using another chain that is like you lock it up on Ethereum, you move it somewhere else, is that even if the other chain is secure, like usually the cross-chain bridge is very insecure, and there's a whole raft of difficult issues to deal with there that basically are insurmountable. So that bridge is what is fundamental to being layer 2, right? So if your cross-chain bridge is a multi-sig, which is to say, 2 out of 3 parties agree or 5 out of n parties agree, which is what we just saw get hacked, 5 out of n parties, and it wasn't exactly 5 out of n, but that's partly a problem because often the infrastructure behind there is not clear. Cross-chain bridges are fundamentally insecure, and roll-up bridges are fundamentally secure because of the basic idea is that there's two sorts of roll-up bridges, and one of them is that you use zero-knowledge technology to prove in every block that the transactions actually occurred, and the other is to use called optimistic roll-ups, which is to essentially assume that you only need one honest party out of everyone that exists in the world, and if that is the case, because the data exists on mainnet Ethereum, then they can take the bond of the dishonest party, basically.
So we'll definitely come back to this. I think we have a lot more to hear. But let me move to you, Thomas. And I mean, you're actually running a bank. You're very much it's the epitome of a centralized institution, regulated. So what role do you see for banks and other centralized institutions in the DeFi world? And perhaps you could also tell us a little bit about the legal framework here in Switzerland, because I think Switzerland has been one of the jurisdictions that's been most far-sighted in terms of adapting the existing laws for the crypto world. So maybe you could take both questions and weave the connections for us.
Yeah, sure, happy to do so. I think, at least in the short to medium term, I believe that banks can still play that role of the trusted gateway for private investors, but also especially institutional investors, to get access to that emerging decentralized finance space. And I believe banks can play that role for 4 reasons, primarily. I think the first one is regulatory clarity. I mean, for many institutional investors, it is prerequisite to make their investments through a regulated entity or through a regulated intermediary, such as a bank. So private and institutional investors can rest assured that if they are allowed to invest or benefit from the decentralized finance space, and they do that through a bank, that the bank has cleared that with the regulator. So there will never be any regulatory legacy in terms of what they've been investing into and whatnot. I think that's the first important element. The second one is due diligence or selection, right? There are so many DeFi protocols out there in the market or in the industry already, and we also heard it, I think, in a previous panel, that maybe not all of them adhere to what you would expect in terms of security standards, technology standards, but also other elements that are important when you make an investment and when you deal with money. So a bank such as ourselves, who have dedicated themselves completely to digital assets and the emerging DLT ecosystem, if we were to offer our clients an access to DeFi, which is definitely something which is on top of our priority list, then we would only allow our clients to take benefit of these protocols where we have conducted an extended due diligence and where we believe we have been able to separate the good from the bad, or the trustworthy from the less trustworthy, or the secure from the less secure, right? I think the third element then is user experience. I think at the moment, probably not everyone would feel comfortable, to deposit some of their USDC into a certain lending pool because they just don't know how to do it, or they just don't feel comfortable, connecting their wallet, which is in place A, with the pool, which is in place B. And I think the fourth element then is whenever it comes to dealing in large amounts of money, there's always an aspect of custody. And also there, you can either, I think we heard it before, you can either trust yourself as much as you can, or you can trust someone who has set up an infrastructure, a governance, a framework in order to ensure secure custody in all aspects. And I think that's also, I think, one element where a bank can play their very traditional role of being a custodian. Right? So that's my answer to the first question. Second question, Switzerland, I think, is really very much at the forefront of enabling use cases on distributed ledger technology. With the coming into force of the DLT Act over the course of last year, I think we have, or the Swiss government has built the basis or the foundation for us to execute transactions on the blockchain, or to embed ownership in financial but also in real assets onto the blockchain in terms of security tokens, which really enables us to now take benefit from that over time. I think, so from a Swiss perspective, on a purely isolated and standalone basis, we are privileged. We are in a very favorable position. But I think in order to ensure that that we will see mass adoption on a more global scale, I think it requires a certain either harmonization across jurisdictions where other countries put similar legislation in place, or they just also come up with a similar framework like the Swiss government did when it comes to embedding that into legislation across different federal laws.
Thank you, Thomas. And maybe we can also get the audience in later. But what about this example that I laid out of the bottle of wine? So there's a very expensive bottle of wine that we have tokenized.
Yes.
Presumably, you need the legal framework to actually secure your ownership. So at some point, it seems that we have to go beyond the blockchain itself. That we need to go beyond the decentralized world and to have some degree of centralization. The legal system being one here. What is your sort of take on the limits to decentralization? How far can we take this?
Well, I think that's probably a difficult question, but coming more concretely back to your example, I mean, you called it a thought experiment. I mean, we did it exactly this on February 1st, 2021, so it's not necessarily a thought experiment, but something that we did, and there obviously we took benefit of the DLT Act that came into force here in Switzerland. We created co-ownership in that bottle of wine, or multiple bottle of wines actually, by making use of the ledger-based security, and put co-ownership of this onto the blockchain, on the Ethereum blockchain actually. Later we moved to Polygon as a roll-up solution, or layer 2 solution of Ethereum. So I think, yeah, what does it need? Yeah, it needs a legal framework that allows to do so. And I think whenever we think about conducting tokenization projects for our clients at Sygnum, I think the first element of that entire value chain that we're covering with our solution is not the creation of a token, but is making a legal and regulatory assessment as to whether, under which circumstances, you can put ownership or co-ownership in such an asset onto the blockchain and wrap it into, for instance, a ledger-based security. So I think, and that element in Switzerland, that legal and regulatory clarity that we need, that is there. So there, I'm not concerned when it comes to Switzerland. But again, there are other jurisdictions which should follow, and some have already followed or have been even earlier than Switzerland was. So, I mean, I think that entire decentralization, but also the tokenization promise, where we believe we can put the entire financial market infrastructure from centralized databases onto decentralized databases in terms of blockchains or DLT. I think there we just need to have the legal and regulatory framework in place across jurisdictions in order to make that happen. And the level of decentralization, well, I think that's then probably a different question, but I think the fundamental prerequisite is really that there is 100% clear legal and regulatory clarity around being able to put ownership in a security onto the blockchain and under what circumstances, because if there is a break between owning the token versus having ownership in the underlying asset, then I think we are in fundamental trouble if this scales. So that, I think, is the most important problem we need to solve, besides, obviously, then the technology challenge that we need to solve.
Absolutely. Well, thank you, Thomas, for that. Let's come back to this, because I think there's the very fact that DeFi inherently is global and cross-jurisdictional, I think does actually pose some interesting questions, if there are discrepancies across jurisdictions.
Indeed.
But Iota, let's go to you now, and let me ask the same question that I asked Thomas, which is the interaction between a centralized if you like, overlay, governance overlay, and DeFi itself, but taken more broadly. So what do you see as the key issue, as being the key issues in the points of contact between DeFi and C5?
That's a very broad question. So if we take a step back and we look at the way DeFi is being developed and is evolving, and we look at it at its interaction with the traditional financial system, the way I see this evolving is through more of a symbiotic relationship, where we will have both kind of systems working together to actually satisfy benefits and incentives from both sides. And what I mean by that is that we have a lot of discussion around whether DeFi is actually going to replace our conventional systems. I don't think this is the case. I kind of see this symbiotic relationship being beneficial for both DeFi and the conventional system. And I'll explain what I mean by that. So for the DeFi system, we know that for the DeFi market to actually grow in a meaningful and substantial way, we need to get institutional and professional investors into this space. And this has to be done in a compliant manner. And indeed, in recent work of the OECD Committee on Financial Markets, we do see evidence of this trend of institutionalization of crypto and of institutional investors wishing to become part of the decentralized finance space. Now, this is going to be beneficial for DeFi because it will allow it to grow to a meaningful scale. And at the same time, Hyun, you showed the very high correlations between the coins that are actually today part of the DeFi system. One of the critical parts of this kind of symbiosis would be the use of tokenized regulated assets in DeFi protocols. And this would, in my personal view, allow for this market to actually develop in a substantial manner and in a compliant manner as well, allowing for this institutional investor participation. From the conventional standpoint, of the traditional financial institution standpoint, this kind of slow integration of DeFi as part of the operations of a financial institution, either in the way that Sygnum does it from scratch, or by integrating DeFi as part of a very traditional infrastructure, will allow the conventional system to enjoy the benefits of decentralization when it comes to cost efficiencies, when it comes to automation and productivity gains, to enjoy atomic settlement, but at the same time, the gradual integration will allow it to test the limits, and we've talked about limits with what Ivan was suggesting previously. So this is kind of the way I see this, this kind of natural evolution and bridging the two systems in a gradual manner.
So that's a very, I think you've raised some very interesting questions, Iota. On the atomic settlement, I think we also heard it from Fabian earlier. You know, we do have experiments, and you know, they're now quite mature within the BIS Innovation Hub. So one project that was a very early project in actually the Switzerland center of the BIS Innovation Hub was Project Helvetia, which was using a CBDC for settlement of securities transactions. And you know, rather than having to wait you know, a couple of days, you could have immediate settlement using a smart contract. So it's payment versus delivery. This, you know, that's the sort of, you know, traditional term, rather than, you know, atomic settlement. But we have those contingent you know, features already in a CBDC system. We also trialed very recently, and here we have Morten Beck, who's the center head, who was leading this. We have Project Jura, which was this multi-CBDC platform between the Swiss National Bank and the Banque de France, where we had the euro and the Swiss franc legs. And we could see that this payment versus delivery also worked, you know, seamlessly in a multi-currency framework as well. So if it's really the atomic settlement, I think it seems that we're already there to some extent. So my question to you is, do we actually need to pin the whole system on speculation on coins? Can we do without the speculation and just have decentralization?
This is, again, a very interesting question. I would go back to the interesting nexus between CBDCs in the way you use them in the pilots of the BIS Hub, the tokenized assets that can be fully regulated and compliant just in a tokenized form, and the DeFi space. I think that the question of the conference itself makes the link between CBDCs and DeFi, and the way we perceive DeFi today is very much evolving around speculation and unbacked crypto assets. But if we focus a bit on the intermediary point of tokenized assets, and we make the link to the importance of having this kind of innovation also participating between CBDCs and DeFi. And what I mean by that in a more simple way is the following. So in France, for example, Société Générale Forge has used tokenized securities as collateral on Maker DeFi lending protocol as a way to actually refinance its tokenized securities, because one of the big problems is you can tokenize a security, but there's no secondary market for it in terms of having a very developed market around it. Of course, we have very good initiatives in Switzerland with the SDX of the Swiss exchange, but these are very limited pockets of liquidity. So if we think about having more of this kind of compliant, regulated, tokenized assets introduced into the DeFi space, we move away from this kind of speculative nature of DeFi itself, and we move closer to the benefits of decentralization underpinning this kind of mechanisms. And the way I see this kind of interaction between the three CBDC tokenized assets and DeFi is that for tokenization to actually reach a development at a meaningful scale, in my personal view, we need to have CBDC arrangements to be able to satisfy the delivery versus payment, as you said, in an atomic way. So if we had CBDCs, this could really spearhead the development of tokenization and tokenized markets. And then those tokenized securities could find a very natural environment for refinancing, for repo, for all kind of secondary market activity within DeFi, which would then give more opportunities for growth in the DeFi space. So adding a little bit an intermediary step between the CBDCs and the DeFi question of the conference, in essence.
Thank you for painting that vision. And let's definitely come back to this, because I think the central bank implementation of decentralization, I think, still relies on real names rather than private keys. So I think it does actually raise a different set of technical issues, which can be solved, but it's not going to be blockchain. It's going to be something else. But before we go there, Jan, let's go to the asset management world and what you're seeing from the clients, and this again. This point of contact between the DeFi world and the traditional financial world. So when you look at the asset management sector, in this area, what is it that you're seeing motivating the clients, motivating the asset owners, and what do you see as being the, if you like, the big questions and the points of contact here between crypto and DeFi more generally, and traditional asset owners, and the traditional, if you like, asset owner, and asset management business.
Yeah, thanks very much. First and foremost, thanks very much for the invitation. I think this is really kind of the first step to bring those two worlds together. And from the past discussions and dinner yesterday, I really realized that we're looking at the same thing from two sides of a coin, right? We look at the same thing, but from a different angle. And it's kind of challenging, and I ask everyone as well to maybe switch sides, not only to look at it from a store of value, unit of account, but as well from a technological perspective, that we can start to talk about the same thing. Regarding your question, so we don't just do asset management. We're a FINMA-regulated asset management company in the crypto space, but we have as well a brokerage business where we trade on behalf of banks primarily and do the custody for them. And there is more, it's more client-driven. It's not that banks approach us and say, hey, we would love to trade Bitcoin. It's more that there's a client demand. So in all our discussions, we should not always talk about financial institutions or institutional investor standpoints, but as well retail and clients, etc. From Switzerland, for people who are looking for an alternative mean of revenue in a negative interest rate environment, but as well in countries where they don't have such a financial industry as we have it here, right? When we talk about financial inclusion, I think that's very crucial when we talk about crypto, because DeFi does the same, or most of it, the same things as we have in banks, right? But we're here in Switzerland, we're the lucky 1% globally. We can walk in a bank, open an account, and then lend or get a credit or trade. Most of the people around the world cannot do that. So I believe that DeFi will be absolutely crucial in financial inclusion, that people with small amounts can get a credit for it, can lend it to someone, get a yield on it, or can trade one asset versus the other. So I think from a Swiss perspective, or from the people here in the room, we should really not forget those people.
So yeah, let me just follow up on the motivation of the asset owners. There was a very interesting paper recently by Antoinette Shaw of MIT Sloan, and Igor Makarov at LSE, where they show that a very large proportion of Bitcoin. So they were mapping the whole of the Bitcoin network, and they show that, and they I think argue very convincingly that a large proportion is actually held in exchanges, in cold wallets.
In exchanges or in cold
exchanges?
wallets?
Yeah.
Exchanges, and they
Yeah.
store it in cold
Yeah.
wallets.
And that seems to be, somewhat counter to the idea that you're actually, using, these, you're using Bitcoin or using, other coins very actively as collateral in these DeFi platforms, but rather you're just keeping it there, rather like a mutual fund. And it raises a question, are they, and in particular with the entry of institutional investors, what is the motive of the large institutional investors to come into this space? Is it more the asset appreciation? Is it the asset price appreciation that they're after? Or is it more the, the functionality that these coins actually give?
I think
give them?
it's absolutely both. First, as I said, it's another mean of getting a yield, a return on its assets, investing in an asset which is increasing in value and not decreasing. But as well, if you want to learn about this new technology, it's like you can read about it, but just doing it is just, your learning curve is much steeper than just reading about it. So really getting into space, trying it out, and then you will figure out what the potential is of this technology. Obviously, we're still at the early days. We'll need to improve that a lot in it, in the technology. We have discussed, we heard it before, but like 25 years ago with the internet, it was exactly the same. So if you talked about, but it's just a hype, or just people are in for the return, I think that's quite crucial, that you get people in, that you get investors in, that you get people like me or other members in the space into the space to get an incentive for it and to build it, and that will lead to something which is much bigger and much more useful over the future, not on the short term, but long term, right?
Well, thank you, Jan. Yes,
Can
Iota.
if I may add,
Absolutely.
and Jan, you will not be very happy to hear this, but based on what we are currently discussing at the OECD Committee on Financial Markets, we have tested the drivers for the undisputable increase in institutional investor interest, and we've tested speculation or search for yield, the use of this kind of instruments as an inflation hedge, and their use as a diversification strategy for portfolio management. And we have seen increased correlation with all major asset classes, so the diversification doesn't hold, especially in market downturns. It becomes even more highly correlated. We've seen that it's not an effective inflation hedge, and everything points to greater use as a speculation instrument. And what is very important when it comes to the philosophy of DeFi serving financial inclusion, while I do not disagree that this conceptually could hold in the future, what the data is showing us today is that almost 3/4 of the activity within the DeFi space is coming from professional or large institutionals, high net worth individuals, family offices, and not from the underserved retail investor who wishes to enter the space. So that is not to say that there is not the potential to use it for this kind of purpose, but we don't see this happening today. And the last point, which goes back to the presentation of Hyun and the way he has shown new addresses and the price of Ethereum, we have done some analysis on the flows that come into DeFi, and it's very interesting to see that the largest part of flows coming into DeFi is coming from DeFi itself. So there is a high recycling of flows within the DeFi space, which could be explained by the fact that there is high use of DeFi today for leverage purposes by family offices, high net worth individuals, and the likes.
Yeah, did you want to come back?
Yeah, definitely, definitely. It sounds a little bit what I said with the internet, like 25 years ago, yeah, only a few people are using the internet. We have analyzed it as of now, and nobody's using it, right? So it completely lacks the not the willingness, but kind of this openness to see, okay, it works. It's a system which could be used by people who don't have access to the financial system. Most of them are not very tech savvy, so you need to have these UIs, these applications, these systems where they can easily interact with it. But what we see now is a very tech-heavy or crypto investor-heavy use of those platforms. But again, very similar to the internet, this is status quo and not what can it enable to become. And obviously, yes, it depends on who you ask. Probably you ask institutional and professional investors for their motivation to invest in it, and then it's probably a way to get an additional return. People who are fleeing Ukraine now or who have lived in Turkey, maybe they have other motivations, the same as they have bought gold in the past, right? But it's just a little bit more heavier to take with you if you need to leave your country overnight. And then, I think it's really that we should be open for it and welcome this new technology to use it. And another thing is we should not over-regulate it and kill it before, right? That's very important because a lot of people will not use it for money laundering or so, but they will just use it for small amounts. And if you require them to do KYC, you need an instance who does KYC, and this is quite intense. And then you will have such high entry barriers for them to enter that they will never participate in it.
I think the KYC, leads us to a very good segue. So, and I would like to also bring in the audience at some point. But Evan, I'd like to ask you a question from your vantage point as a venture capital investor. So, what are you looking for when you're scouring the universe? And you, I think, laid out very eloquently the trade-offs there between capacity and security, and the Buterin triangle. So, tell us what you're looking for when you look at potential projects?
Yeah, well, I'm looking for founders that can execute, and I'm looking for technology that makes sense and that can go out and find real-world use cases. I mean, one great example is you talked about financial inclusion. I'm looking for people that can go out and not only make the case for the rest of the world, but also in ways that make it easier for them to use. So I have lived in, my wife is from Argentina, so I've spent quite a bit of years down there, and we were just down there for a month. And there's really a difference between those of us in countries that have stable banking systems and people in Argentina who do not have stable banking systems. And it's easy for us to poo-poo, oh yeah, crypto doesn't really matter, but it's literally life and death for some people to be able to have access to dollars and be able to flee the peso and a system that has robbed them of their savings, has robbed them of stability through corruption and just terrible, incompetent governance. And it's real. I mean, you can be in Argentina and the middle class, the working class is buying DAI, they're buying USDC. They are doing anything they can to get out of the incredible inflation, which the government lies about. They like to use DeFi, right? They want to be able to get a return that is on their DAI or on their USDC, which is 2 or 3%, which in dollars is world changing and life changing for these people, and really that's who DeFi matters for. And of course, crypto and blockchains can't solve the fact that the world is imperfect and has a lot of inequality. But so it shouldn't be surprising to us that given like the way inequality is in the world, that most things in DeFi do come from rich people. But it's really what matters is people down in the trenches who do not have access to stable banking systems, and being able to have things in DeFi that do replicate anything that you could get in a bank in an advanced developing country like Switzerland, and not have their savings stolen overnight in the Corralito. So, yeah, that's why it matters.
So, Evan, I think you've laid out quite a sort of I would say quite a controversial view of the interaction between the central bank-based system and DeFi. I mean, let me put it this way. If the conventional system has weaknesses, and we had the choice between improving that system versus rejecting it completely, wouldn't it be better to improve that system so that we can actually have the system working better? So I guess that's one question. The other question for you is more of a technology question. And this goes to the vision of decentralization that's inherent in many of the BIS Innovation Hub projects. Decentralization is, I think, very important and a very important, I think, productive step in many ways. And in some ways, it's actually necessary because when we have a cross-border multi-CBDC system, as we call it, there's more than one currency, and therefore there's more than one central bank, and so decentralization is more or less inevitable there. And the way that we've done it is to use decentralization, but using real names. So we don't use private keys. Everyone has their real name. But then we need the privacy of our transactions, so we cannot just put it on the blockchain for everyone to see. And so we have to use some other means of preserving privacy. It's the same public key cryptography, but used by keeping track of the unspent transactions, zero knowledge proofs and so on. So definitely decentralization is important, and I would even say inevitable. And it's a kind of different vision for decentralization that doesn't have the coin speculation attached to it. And in a way, it's come with greater scalability because you don't need to incentivize the validators. You can actually scale because this is very much part of the central bank vision. What do you feel about that vision of decentralization? Is that going to be compatible with the crypto ethos?
Yeah, there's a lot to unpack there. Let me start with one of them, which is that does coin speculation matter? Yeah, I mean, Bitcoin and Ethereum, proof of work is really just an inefficient form of proof of stake. And these native assets have to have value in order for the systems to work. That's what gives the decentralization to it. You are actually staking you can only mine Bitcoin by staking your money in a very expensive hardware system that is frankly useless outside of mining Bitcoin. It only runs that hashing algorithm. Proof of stake is a little bit different in that it is much more capital efficient and and can be much more decentralized. Now, should the systems should we switch to another system? Should we I think that's just a question of technology. And I think in the long run, technology always wins. And as a technologist, I think you can look through the history of technology, and it's easy when it's in a nascent state, and it is still in a nascent state right now, to say that this isn't going to work, and there are all these problems, and this isn't really going to be a thing. And look, I come from a long line of technologists, but we're also very skeptical people. I don't know, it must be the Dutch genes. And my dad and I were talking in the early 90s about how this thing was never going to be a real thing, because who was ever going to put their credit card into the internet, into your browser? Like, we knew all about how these systems worked. Nobody was ever going to do this. It's crazy, right? Well, it really wasn't that crazy, and things evolved, and I think in the end, like, there is the march of progress is inevitable. I think it's really just a question of how things get adopted. I think CBDCs are inevitable. I think that it'll be great to issue them. I think, well, like people in Argentina would love to have, a Swiss National Bank franc, right? Like, they would love to be able to use that. They might be a weird case because, they love the dollar. They have more religious faith in the dollar than anyone possibly on earth, including Americans. But if they could get the franc, I mean, the franc has a long history of stability. So I think they would like that too.
Very good, very good. So Thomas, let me come back to this question of the bottle of wine and the jurisdictions and the blockchain. And actually, we have MM here as well, actually, later. So we can maybe delve into this a little bit further, or even maybe we can have a comment from the floor as well. How do you deal with that kind of disputed ownership? And how does tokenization actually deal with that?
You mean with the question as to whether ownership in a token also represents ownership in the underlying asset?
Yeah, so say that I have a token on layer one, one layer one blockchain. You have a token in another layer one blockchain. You're in one jurisdiction. This other person is another jurisdiction. It points to the same bottle of wine. How do we deal with that?
Well, I think that should never happen, ideally, right? No, well, I think that's a very difficult one, right? I think initially, and I think we heard it in a previous panel as well, there must be an element of trust, right? And I think technology can provide trust because, transactions are being executed in an immutable and irreversible manner. So, if a transaction has happened, it has happened and it is final. Now, obviously, before there can be a transaction, there must be a process of putting ownership in an asset onto the blockchain, right? By minting the respective token. And that process, ideally, before that process happened, there should ideally be an analysis as to whether we can, as I said before, as to whether we can embed the ownership in such an asset onto it or into a token and put it onto the blockchain by applying the legal and regulatory frameworks that are in place in the respective jurisdiction. And that, I think, at the moment, probably there's no really good way, at least I haven't seen any, to also embed that information into the token itself and make that visible to anyone. Hence, you need someone or trusted parties in the market or in the industry who can do that for you, right? Who can write the contractual framework around it to ensure that there's no break between having ownership in a token and having ownership then in the underlying asset. And that's, to some extent, what we are doing at the moment as a bank. And as a bank, in the end, what we sell is trust and peace of mind, that whenever you deal with assets that have been issued through our platform, there is a binding claim with regards to the underlying asset. And there are many other institutions out there who can provide the same trust as well. But having the means to do so in the first place, in terms of having the legislation in place, I think is the first step. Again, we are very privileged here in Switzerland that we have the legal basis. That is, I think, undisputed. In other countries, it may not exist to the same extent. And you, as an individual or as an institutional investor, you don't want to have the burden to, whenever you want to buy a token, you have to analyze or investigate as to whether this token had been issued under full legal and regulatory clarity in the respective jurisdiction. So there, I think, we need to find ways. Either the governments find ways in order to harmonize legislation across countries to enable that, and then we can just trust. Similar like we trust today that if a share or stock is being issued under US law, there is a rightful claim towards the dividends of these companies and exercising voting rights if there are any. And the same, I think, will emerge at some point with tokenized assets, that we can just trust that there is the legal basis in place that allows you to do that in a proper and bulletproof manner. But I think it will take us quite a few years in order to establish that without any borders.
Thank you very much, Thomas. I'd like to give some space, a little bit of time to the floor as well. Let's see if we have any questions. Henry, do we have some microphones that we can hand out? Yeah. So let me turn to the floor. I think we have a question over here.
Hit us
That's
with
the
your
third
best
row.
shot.
Yeah. No, just behind. There we are.
That would actually be a question to you. Yeah, so have you ever seen in the history of humans a fundamental innovation that was not kind of matched by euphoria and speculation? I think it's just natural that we see this.
Totally agree. Yeah. How do you have innovation and like change, have a paradigm shift without people getting crazy about it before it's really a thing? But it happens. And Web 1 was reading only, Web 2 was reading and writing, and Web 3 is reading, writing, and self-sovereignty. So you get to own the things instead of relying on centralized databases.
So Alex, I think a very interesting question for us to ponder is whether we need continuously rising prices or whether we can level off at a very high level. If we level off and stay there, or we follow Hotelling's rule and we just have we just have appreciation according to the rate of interest, is that going to sustain? I think that's a really interesting question for us as economists. Or do we need continually appreciating coins in perpetuity? Yeah. Okay, so I think we might be getting into a debate, but Alex, go ahead. Oh, okay. Next question.
So thank you very much for this presentation. I would like to stir the pot a little bit and ask, on this CBDC and DeFi topic, like we make it seem as if this is really possible, right? But if I look at DeFi, what's actually happening, a lot of the assets that are being onboarded that have some level of centralized control, which, for example, for a national bank is required by virtue of its mandate, is largely rejected, right? So usually assets, if we look, for example, at MakerDAO, every time we see an asset that is a question of being onboarded with any sort of backdoor functionality, that's just rejected. So what is going to give here? How does this really look like?
Actually, we have two panels this afternoon on exactly this topic. So let me not steal the thunder of the panels, in the afternoon. Yes, but Iota has
just to give
point.
a very short example of this actually happening in sort of a mitigated way with the institutional versions of some of the large DeFi lending protocols. So we have from Aave, we have Aave Arc, where you have a pool of whitelisted institutional investors, right? We are doing the customer due diligence, the AML and CFT checks. So you are actually kind of allowing a compliant version of your DeFi protocol in a permissioned manner while still having the permissionless DeFi protocol alive on the side. So there are ways that are in between that you can consider already happening.
And actually, the two biggest stablecoins are USDC and USDT, and both have block list functions. So, and they are widely adopted.
Iota.
Yeah.
What is the volume in terms of Aave Arc to Aave?
I don't have this.
It's a fraction. So probably the regulated way will never succeed, right?
No, but still, I think I would go back to your point, Jan, right? You said before that obviously whenever innovation is happening, we're not going to the perfect state from the very beginning. But I would also see that as an experiment, right? We're in that innovation cycle where there needs to be incentives, where there probably needs to be speculation to keep it rolling. And also there, I think Aave Arc, probably they wouldn't call it an experiment themselves, but I, to some extent, also see it as an experiment. Can such a pool that requires the participants to be KYC before and be accepted by the governing body, whether that can survive, yes or no? And I think we will we make use, or Aave makes use of the beautiful technology in order to enable that. Whether it will survive, I mean, we also see it. Volumes are super low, yields are correspondingly low as well. But I would also see it as part of that innovation cycle. And if it survives, I think it's beautiful because it may make life much easier for us to get closer to that access to decentralized finance through a regulated institution, right? And if it doesn't survive, yeah, then so be it. Then that's probably just the collateral damage that we have been causing when going through these innovation cycles.
Can I also add, you are comparing two things that are not at the same state at the moment, right? Because the DeFi protocol of, the decentralized protocol of Aave is currently in a bit of a limbo in terms of regulatory compliance. And I try to avoid regulation in all my interventions, but we have to also admit that some parts of the DeFi protocol's activity are actually regulated activities provided in a non-compliant manner. And I'll give just one very simple example, the governance tokens. In some jurisdictions, governance tokens could be having characteristics that are similar to investment contracts or even to securities. So we cannot compare the two levels of development because they are not actually, we're not sure this is going to be a sustainable way forward for the decentralized protocol, while there is still a bit of absence of clarity about the regulatory framework applicable.
Yeah, absolutely agree. I think as well what you said, right? Probably it's going to be two-phased. So first, we have more like it's just up and running, and then we will need to have an institutional kind of platform which fulfills all the regulatory requirements. But in the real world now as well, we don't have eBay is not regulated. Why don't they need to be regulated? They are transacting a lot of volumes, right? So we should adhere to this one in the crypto space as well. And if I'm just transferring small amounts in and out, then I shouldn't fall under the full stack of an institutional player. But if I participate as a bank or as an institutional investor, then obviously I should participate, or I should have the same regulations and requirements as in the traditional world.
Well, all good things come to an end, and I see that our time is up. Well, this has been a tremendously rich discussion, and I'm sure the panel, the two panels this afternoon will also follow up on this. I guess it's Morten, we've teed it up very nicely for the key question. What is the relationship between CBDCs and the technology here as well? So, Evan, Thomas, Iota, Jan, thank you very much for this very good discussion, and thank you all.
Your next one will be at the OECD.